Okay, good morning everybody and welcome to this AVI Global Trust interim results presentation. This morning I'm joined by Bauernfreund, our lead portfolio manager, and Tom Treanor, our head of research here at AVI. Usual format that I think we are all used to at this point in time. We will trot through the presentation for about 20-25 minutes, followed by Q&A. Your microphones will remain on mute and your cameras will remain off for the duration of the presentation. But when we come to Q&A, you are able to use the Q&A function at the top of your screen, and I'm happy to ask your question for you. Or if you'd rather ask yourself, there is a hand raise button that you are able to use. And with that, Joe, off we go.
Thank you very much, Helen, and thank you all very much for joining us this morning. So Tom and I will spend about half an hour describing to you how AGT is positioned, where we're seeing opportunities and some changes in the portfolio. And as Helen said, thereafter, we're very happy to take some questions. So by way of introduction and reminder, AVI Global Trust is just under 1.3 billion pounds of assets. We sit in the global growth sector. Some key features of the portfolio and the strategy are worth reminding you, and that is we are heavily benchmark agnostic. Our portfolio looks very different to most other global strategies. Concentration, top 10 making up just under 60%, and quite a limited number of holdings within the portfolio. Over time, we've performed well. And as we move on to look at the performance over the period, you'll see a very well-known feature of global markets over the last decade or so has been that very strong performance of US markets, reflected in the very strong performance of the world index. 2024 was characterized by extremely strong US performance, but as we all know, that period appears to be coming to an end for the time being. And what we've seen is the resurgence of ex-US markets. And given the volatility, it hasn't been a very strong absolute period of time over the last 6 months, but much more in-line performance with the index than what we saw in 2024. The good thing is that some of the characteristics that we're beginning to see in the market and in the general environment really speak to our strengths and how the portfolio is positioned. As you saw on the previous slide, our portfolio is largely exposed to ex-US markets, very heavy underweight to the US and overweight to Europe and overweight to Japan in particular. And when we think about the opportunities in the marketplace, what's particularly interesting is when we start to look at valuations, and valuations on our universe, most importantly. Valuations today, as reflected by the discount on our portfolio, really are at extreme levels. There are the kind of levels that we've observed historically during times of extreme market dislocation and stress. And certainly up until the last couple of months, the environment has been more benign, but nonetheless, discounts on average have pierced through that 40% level. And what that means is valuations are very attractive. It means that risks or the headwinds of discount widening are quite limited. And the drivers of performance going forward should be idiosyncratic factors, should be catalysts that we see in place for discount narrowing without the extreme risk of discount widening. When we look back over the past 6 months, it's been an opportunity for us to realize some profits and take some profits out of some of the strong performers, notably Apollo, but also to add to some interesting situations. Interim gave us an opportunity with some inefficient pricing in the market. News Corp continues to screen particularly attractively. There have been some detractors, as you'd expect, but again, market setbacks have been quite helpful as we've been building positions, for example, in Gerresheimer and in Roto in Japan, to take advantage. And certainly, as we've been able to exit out of successful investments, there's been no shortage of new ideas coming into the portfolio. You see that reflected quite heavily here. 5 new names that we've highlighted here, the largest increases to the portfolio, with on the other side some partial exits, but three full exits, profitable exits from situations that have been in the portfolio for a while. Again, looking at the opportunity set and thinking about market dynamics, when we look at the new entrants to the portfolio, it's dominated by Europe and Japan. Exits come from special situation, SoftBank, but also Apollo, obviously very, very US heavy. So I'll put this up here at this stage so you can see the full portfolio listing. And we're very happy to take questions on any individual holdings when we come to the Q&A at the end. For now, I just highlight the concentration, the level of discounts on the portfolio, and Tom and I will pick through a few examples, a few case studies to highlight some particularly interesting opportunities. But as I say, happy to come back to this slide and answer questions on any particular holding.
So before we go into case studies, a brief overview and reminder of how we construct the AGT portfolio. First point to note is that we are looking in what we believe to be much less efficient areas of the market. You'll all be aware of how narrow the indices have become over the last 10 years, particularly over the last 5 years or so. And we firmly believe that the further away from the index you go, the better your chances are of outsized long-term outperformance. So we have a proprietary database, which we call the Hub, which houses estimated NAVs and models for over 400 core companies in our universe. We're constantly screening that for outliers in terms of particularly large NAV moves, discount widening, looking for discounts that are wider than peers or wider versus their own history as well. And then when or if that throws up ideas to look at a lot more closely, we're doing very, very intensive research on prospective portfolio companies. We're really trying to get to a point where we think we understand them better than anyone else in the market. And that will involve using non-traditional sources, expert networks, etc. We're really trying to find opportunities where there's not only a wide discount to assets that we like, but where there's a very clear, in our mind at least, corporate event or catalyst that will narrow or completely eliminate that discount to NAV. And that can be either self-help measures. You may have a management team or family decide that the shares are far too cheap and take unprompted action. Or increasingly, it'll be a situation where we create our own catalyst for engagement with boards and management of portfolio companies. And what that ends up in is a portfolio that is concentrated, as Joe put it out in the last slide, on a look-through basis is reasonably well diversified across a number of holdings, sectors, countries, etc. We're looking really for the holy trinity of assets that are what we believe to be high quality, that are growing in value, that are durable and resilient. And that really allows time to be our friend. We're looking for a large discount to net asset value. And then I touched upon earlier on, some form of catalyst there that often we can create ourselves. And the best events, or rather the best investments we find, are those that combine all three of those criteria. Now, activism, many of you will be aware of our engagement and activist efforts, but I think the point we're trying to get across here is that the vast majority of our engagement doesn't see the light of day. So we're engaging with almost every company in the portfolio in some form or another, and that can stress from very mild engagement to very, very intensive. But there's only a handful of situations where the public glare ends up finding its way upon our investments. And that's really a choice from our point of view. We'd much rather come to an agreement or solutions in private, but the very fact we are willing to go public, we believe, increases our chances of a successful outcome in private. Just really to highlight here that there's not a one-size-fits-all approach to engagement, that there's a very different methodology and approach and tack taken to, say, a Japanese operating company. or a closed-end fund in London, or indeed a family-controlled holding company in Europe. So one particular area where we see very compelling opportunities is the London-listed closed-end fund landscape. Many of you on the call will be aware of the perfect storm that's hit the sector over the last 3 or 4 years or so. You clearly have issues around cost disclosure. You have investor aversion to the UK, multi-asset outflows, etc. But really at a high level, it's that we had a 15-year boom in issuance of alternative income-focused vehicles. And we're now in what we would characterise as the great unwind of that. And while that will mean, we believe, a much smaller sector, we're going to see more funds going to wind up and run off. We're going to see more and more take privates as well. That creates an incredible opportunity set from our point of view for generating outside returns in this space over the next 3 to 4 years. We're talking about areas there like listed PE. We have very much entrenched discounts there. You have large GPs with evergreen vehicles now that we think do form a long-term threat to the London listed sector. And with that comes opportunities, we believe, for corporate activity and substantial discount narrowing.
So Japan continues to throw up really a huge number of opportunities for us, both from a valuation perspective and also from an activism perspective. After 10 years since the Corporate Governance Code and Stewardship Code were introduced into Japan, over the last year, we've really started to see a massive change in attitudes by companies towards shareholders. There's been a really noticeable pickup in corporate activity, in transactions driven largely by private equity firms, but more importantly and more fundamentally, a change in the welcome we're seeing from companies when we appear on the register, and the willingness we're seeing also from them to listen to us, to listen to our suggestions, and to implement some of what we suggest. Japanese activism differs from that of closed-end funds in that the requirement really is to be much more respectful of Japanese culture. We're not necessarily the largest shareholder in all cases, and it takes time to build up that trust. But nonetheless, our activism is rooted in solid fundamentals, in really an aim and ambition to help the companies increase the value of their companies over the very long term. And it's been a pretty fruitful place over the last few years. And from our vantage point, it continues to throw out, as I say, a large number of opportunities. One recent example of activism, this is not in Japan and it's not in closed-end funds. I suppose it's a more mainstream European company, is with the German conglomerate Gerresheimer. Gerresheimer is an interesting situation. It's a pretty good business focused on pharmaceutical packaging. It's had some growth in the delivery of the pens for weight loss drugs, but it's been poorly run. It's been undertaking a strategic review for a while now. It's drawn attention from a number of private equity investors, and some of the decline in the share price in recent months reflect a couple of different factors: poor management, some profit issues as well. But really, it's ripe for quite a lot of pressure on management from more activist shareholders, and we've been taking a bit of a lead on that. But there are certainly others involved, and it's just a good example of situations that are appearing in Europe that are deeply undervalued, where there are substantial upsides, and where being more proactive is really key to unlocking substantial value. Another example from the portfolio, which has been growing in portfolio terms over the last few months, is Vivendi. Of course, we used to own Vivendi many years ago. Some of you will remember that. Vivendi is a very different company today. And following its structural changes over the last six to 9 months, which basically saw it simplified into a a mono holding company for effectively the stake in Universal Music Group, it's become really attractive from our perspective, really undervalued, and it's hard to see why the market is penalizing it with a 48% discount when it is really simple. Universal Music Group is itself a listed company. The value is very transparent, and not only is it on a 48% discount to the value today, but we are highly confident in the prospects of Universal Music Group, both in terms of its growth opportunities and also in terms of its valuation, which, as you see here, lags quite dramatically when looking at peers.
Just a case study from the closed-end fund bucket in the portfolio, and also now our largest holding within the portfolio. Many of you who know investment trusts will be familiar with Chrysalis Investments. Since it's a late-stage venture capital fund that launched about 6 years ago now, went to a very large premium to what was in hindsight a very inflated NAV in late 2021. And then when the music stopped and the rate cycle turned, we saw the shares go to extremely wide discount to a NAV that had been written down substantially from its 2021 peak. That naturally appealed to us as contrarians, and having done a lot of work on the portfolio to underwrite the reported figures, we initiated a position rather in early 2023, and we've grown that to the point where AVI is now the largest shareholder in Chrysalis by quite some distance. We own just under 17% of the shares across mainly AGT, but some other AVI accounts as well. And our focus right now really is on an engagement with the board over what the company's future looks like. And in particular, when they do come to exit investments, where does that cash go? Does it go to new investments, follow-on investments, or does it come back to shareholders in some form or another?
So Helen, you'll be pleased that we've kept it relatively high level, kept it to less than half an hour, and have deliberately gone through relatively quickly so that we can take some questions and address some of the points that you want to hear from us about. But just to end, just in summary, I think it's clear that stock markets around the world are going through a shift. There's questions over valuations in the US, there's questions over other issues in the US. But what it means is that investors are looking outside the US, and that really hasn't happened in a big way for the past decade. That's good for us. We're very much focused on opportunities around the world, but the portfolio is tilted heavily to ex-US markets. But more fundamentally, what is helpful for our strategy is investors who care about valuations, who care about catalysts for unlocking value and are prepared to do the work. And the shift out of the US really reflects those kind of characteristics. We're in a market environment in which investors are becoming more discerning, more interested in valuations and catalysts. And to the extent that our universe is screening extremely cheaply, extremely attractively, we're able to build a portfolio of companies that have got very attractive growth prospects, so potential for NAVs to go up. But our starting point is on average around just shy of 40% discounts. And the combined force of NAV growth and discount narrowing, we are confident should lead to compelling investment returns looking forward. And the icing on the cake is our activism and our shareholder engagement. As Tom told you, in most cases, we are engaging. We've got an agenda with companies. Sometimes that goes public. Most of the time it stays private. But the key is we're really working hard to unlock value. And the positive side is that in many cases, management are keen to listen to us, to implement our suggestions, and to help deliver strong shareholder returns. So I think the starting point is very attractive for AVI Global from here. We've managed over many years to more or less keep up with the world index without having big allocations to the US. But going forward, I think the dynamics are very compelling for us. So with that, I'll end, and maybe I'll take us back to the portfolio slide, and if there are any questions on anything we've said or anything we haven't said, let's take those.
Brilliant. Just as a reminder, you can use the hands up, but you will have to unmute yourself if you choose to use that function. But I see that a couple of you have figured out how to use the Q&A facility, so I'll start with those questions. When engaging, have you noticed any changes in boards' attitudes over the last couple of years?
Yeah, I'll talk about Japan. You talk about investment trust. So in Japan, absolutely. It's fair to say that when we launched our dedicated Japan strategy 6 or 7 years ago, companies recognized that times were changing and that they would have to start meeting with us, start listening to us, and there was pressure on them to address some of the fundamental issues. But if you think about it, they weren't that welcoming. There was a foot, if you like, kept against the door. It opened a little bit, but not a lot. More recently, our experience has been that the door has been thrown open and in some cases welcomed with open arms, in some cases with a bit of trepidation. But I think the key message is that in Japan, companies have recognized that they do have to do more for shareholder returns. It's good for them. And that way you've got a shareholder who can work constructively with them, not embarrass them necessarily in public, then they seem quite happy to listen to us and engage with us.
In the closing fund space, the answer is definitely yes as well. I think boards are now recognising and realising that the rinse and repeat cycle of the sort of 2010 to 2021 era, where you would trade at a premium, issue stock every year or so, invest out and so on, and people realise that that model no longer works at all. You're seeing more and more boards recognise that they need to have some form of capital allocation policy. I think moreover, the bigger change I've seen has probably been a bit more impactful is the willingness of shareholders to engage with boards. Lots of holders that you never would have thought historically would engage with boards on discounts, capital allocation, etc., are now doing so. That's a very welcome thing for the sector.
Okay, the next question is on M&A in the UK market, and do you see this as an opportunity when looking at companies to invest in?
Well, M&A generally is a great opportunity, and it's always something we think about. When you think about it, we're buying companies that have a value today of £1, and they're trading at 60 pence. And M&A, in theory, ought to capture much, if not all, of that discount. But the thing about M&A is that we're not in the driving seat. We're not launching takeover bids, and one can never be 100% certain of a bid emerging. It's certainly helpful to have as a tailwind. And that's why our focus is really on a couple of different aspects. We want to be buying companies where that pound of value is growing. So notwithstanding whether that takeover bid emerges, we can generate strong returns. And if that bid does emerge, then great, that's an additional source of return for us. And it's certainly helpful to be operating in an environment where there are those animal spirits and where we are seeing more corporate activity.
I've just been told on email that for some people the Q&A function doesn't work as it's now a paid subscriber thing. So if you want to ask a question, please email me. I sent you the presentation this morning. It's Helen, Mattia. But we've had a question come in on email about the Jardine Matheson holding.
Yeah. Jardine Matheson has come back into the portfolio over the last few months. It's one that over the years we've owned previously and have owned for a long time, going back quite a few years. It's come back into the portfolio for a number of different reasons. First of all, of course, the discount is wide. It's almost 40%. The underlying businesses are doing well and are trading quite attractively in our minds. But also more fundamentally, the reason why now is that there's been a bit of shift in the family structure. There's been a generational transition, and there's also been a strategic review that has looked quite critically over the last few years, seen missed opportunities, and the company is moving more in a different direction, certainly more proactive in managing their portfolio, not getting bogged down themselves at the holding company level in the operations of the key businesses, focused more high level, and certainly more cognizant of the opportunities to create value and to drive a narrowing of the discount. So it's a relatively small position for now, but certainly seems quite attractive and certainly moving in the right direction.
Okay, thank you. Historically, what has triggered a better period of discounts closing in value companies?
I think when we look at our universe, and certainly over the last few years where we've seen really wide discounts, and we then compare or contrast that to periods of time when discounts were very narrow, one of the things that has been missing has been investor interest. So the period of very strong performance for these kinds of companies between, say, 2003 and 2007 was the fact that investors were looking at ex-US quite heavily, and they were looking for companies that were cheap and where something might happen, and where you've got a very wide discount, an explicit discount, that was quite exciting to investors. We haven't had that for the best part of the last 12, 15 years. What we've had has been focused primarily on growth, focused to a large extent on the US, and focus on just the largest companies, rather than an environment in which investors have been keen to do the work, to roll up their sleeves and really look for value. And that's what I think is really changing. I haven't seen a mass exodus, but we've seen at the margin money looking outside of the US. We've seen money, capital, more interested in valuation than it has been over the last few years. And the fact that you are seeing more investors, whether it's private equity, whether it's activists, just taking advantage, seeking to exploit these undervaluations, it's a much more conducive environment for these kind of companies. And if the starting point is average discounts of 40%, that's even more compelling.
Thank you. The next question is for Tom. Do you think that consolidation within infrastructure and renewable investment companies is a good solution to prevailing wide discounts?
Probably not in the short term, possibly in the long term. I think to flesh that a little bit more, I think if you're going to take one highly rated trust that merges with a less highly rated one, there's clearly a gain there. For one shareholder base at least. I think investors definitely want to see fewer, larger, more liquid vehicles. I would question the short term though, whether putting together, say, 2 solar funds that trade at 35 discounts to NAV, whether you really do see any short term narrowing there.
We have a question on Chrysalis. Can you comment on the current Starling valuation and expected time horizon as to how this one plays out?
So Starling is an investment that looks like it's carried expensively when you compare it to the incumbent peers like NatWest, Lloyds, etc. So we estimate Starling's carried at around 2.2 times book in the reported NAV. Now that may seem very high when you see the peers trade around book or at discount to book. But the key difference here is the return on equity that Starling can generate due to the superior tech stack that it's got. So Starling's ROE is around 30% or so, which can justify a price to book of around 2 times. So we would say that it's fairly valued given where it is in the reported carrying value. The second portion was, sorry?
The time horizon.
Time horizon. I mean, there's been talk about a listing, nothing concrete at all. I wouldn't expect an IPO probably any time in the next couple of years.
We've had one final question submitted, so if you do have any burning questions, now is your final chance. But Tom, what % of the portfolio has an asset value and what percentage is companies? And therefore, how comfortable are you with the asset value to calculate the discount?
Percentage in companies, sorry.
Yeah.
Well, I would say that every company has an asset value or a target valuation. Every company that we've got owns some kind of assets, whether they're listed or unlisted. But the key to our approach, and Tom mentioned the proprietary database, the hub, at the start, we are, even when we're valuing unlisted assets, we're valuing them on a live basis in relation to where peers are traded in the listing markets, and that gets updated constantly. So everything really has a value and a discount.
Yeah, I suppose what the question might be getting at is obviously there's operating companies in the Japan portion of the portfolio, but because these holdings tend to have very high cash balances, property holdings, shareholdings in other listed operating companies, we can adopt a sum of the parts approach for them. So every company, be it ostensibly an operating company, they all have an NAV to which we can calculate a discount.
If that wasn't a clear enough answer, please do send through a follow-up question and we'll try and get to you, as we've just had a couple more come in. So the reported gearing ratio indicates fairly sizable cash holdings offsetting the structural gearing. Is this an allocation call or a byproduct from sales pending reinvestment?
So the current gearing on the portfolio is around 6 or 7% geared, and we've got total gearing capacity of around 14% currently. So yeah, we've got some firepower in reserve, but we are geared. 7% isn't out of line with where we've been over the last few years. We've got some new names coming into the portfolio, some new names we're working on, and I'd expect to keep the gearing high single digits, early double digits for the most part, looking forward.
Okay, what is the average discount on the portfolio, i.e. the underlying look-through?
Got a slide on this. Second slide, isn't it?
Yeah, so it's just shy of 40%. I think it's about 38.5% today, which, as I said before, as you've seen, it's really wide in the historical context. During COVID, we hit around 46% for a couple of days. Previously, during financial crisis or the Euro debt crisis, we rarely pierced 40%.
And I think this is our last question, which is quite a nice one to end on, actually. With such a rich hopper of new ideas, how do you decide what makes a place in the portfolio?
There's lots of fights going on in our investment meetings, which, joking aside, is a fantastic situation to be in. There's competition for capital, which means that we're really focused on the best, highest conviction ideas. The positive thing is that ideas are coming from all parts of the universe. It's not just one segment that's throwing up great opportunities. There are some new areas emerging, which could be quite interesting. Just to highlight one example, there's quite a lot of change going on in Korea in terms of corporate governance reform. There's been some uncertainty over the last year about the commitment to that, but there's some political change, and that's an area that we're doing a lot of work on. But really, it's about balancing, having the concentration, really differentiating ourselves from other global funds by backing our conviction. So you see at the top end of the portfolio some high conviction names, but also by ensuring that we've got meaningful exposure to other ideas where we think things are happening, and particularly interesting opportunities. So I think we'll always remain relatively concentrated, as reflected by the top 10. We may, in this environment, start to see a small increase in the number of overall holdings, but I think we'll always be benchmark agnostic and very concentrated.
So a couple of more questions have come in before we call time. Korea has copied Japan's reforms on government and appears very cheap. Do you think this is an opportunity?
Yeah, I think Korea is an opportunity. We've been doing a bit of work, have a little bit of exposure now to some Korean companies, and I expect that could well grow. As we've seen in Japan, corporate governance reform takes a long time to really permeate the mindset of companies and investors in Japan. In some senses, Korea has learned from what's gone on in Japan over the last 10 years, and what they're talking about is more direct and more of legal force, really, to enforce change. So that could be quite helpful. But there's certainly a lot of cheap companies in Korea, a lot of big discounts. So yes, the answer is it is an opportunity.
And I think this is our last one. US investors have bought Europe, but not Asia or Japan. Asia looks especially cheap. Will you be upweighting? And to tie there, do we have anything in Australia?
Okay, so we've got nothing in Australia to deal with that for the time being. But I agree with the question. There's been a lot of focus on Europe, and from what we see, Asia and Japan do look cheap, and they haven't grabbed the headlines yet. Jardine Matheson gives us exposure to companies in Hong Kong, companies in Indonesia, and broadly across Asia. And we're certainly looking in the region, and I expect that exposure will grow in time.
Okay, that is everything.
Great.
So thank you everybody for joining us. If you did have any follow-ups you start to think of, please do just let me know, and we can either jump on a call or we can answer your questions via email. And as always, thank you for your support.
Thank you.
Thank you.